that is PCE data, rises slightly on an annual basis to come in at 2.7% in the month of August. While this is in line with what analysts were penciling in, the September that in June this figure was at 2.6%. The core PCE data, which excludes food and energy prices, came in at 2.9% in the month gone by. Inflation, however, continues to remain the Fed's 2% target, which it is mandated. Joining me to discuss the PCE numbers, we have with us Arnav Das, a global macro strategist, EMEA at Invesco. Mr. Das, welcome to ET Now. My first question to you is, with the latest numbers of PCE, do you think it will have impact on when the Fed meets next time?
Yeah, look, I think the numbers came in line more or less with expectations, and in the context of upward revisions to GDP earlier in the week and strong consumer spending data. So I think it's I guess it's good in a way that the economy is continuing to be strong, that the impact of tariffs on inflation continues to be somewhat muted, although inflation is somewhat above target, and there is a risk that inflation will, at least goods price inflation, will continue to come through and keep the inflation rate above the target. I think the bottom line here is that with the economy continuing to be strong, but without very strong inflationary pressure and some signs of continued softness in the labor market, that we're looking at a bit more of an easing cycle over the months ahead from the Fed.
Right. Now, Fed had clear-cut given a statement that it is still above the target level of 2%, and the concerns still remain. How do you think Fed will gauge the current data? More importantly, do you think the guidance which was provided in the last Fed meeting, do you think they will stick to that?
Yeah, look, I think they have to, continue to be data dependent, and continue to signal that they're going to be vigilant about inflation. After all, there was a credibility cost to the idea that inflation after the pandemic would be transitory. It eventually did come down without much of a sacrifice in growth or employment, but only after a significant amount of tightening by the Fed. Excuse me. So I think they will have to be careful, and of course they'll also have to be careful to guard perceptions of their independence. Excuse me again. Given all of the challenges to the Fed from the administration generally and the president in particular, but I think the dynamics have changed a bit so that the softening in the labor market and the argument by Stephen Miran and others that the potential growth rate or that the neutral rate of interest is somewhat lower, given a lot of the changes that are taking place. I think there's some truth to that argument. Maybe not as much as some people would like to believe, but the Fed is in restrictive territory. And with the economy showing some signs, especially in the labor market, of slowing down, it makes some sense for the Fed to tilt from the inflation mandate to some degree to the employment mandate, right? And that's the direction of travel here. I don't think we're looking at the kind of radical rate cuts that some have been calling for, but maybe a somewhat softer stance of monetary policy that gets the interest rate closer to neutral over a period of months. Not rapidly, not very low, but lower than where we are now.
Well, point taken. But as far as the growth is concerned, do you think the latest data which has come in this week does suggest that the situation is slightly better, and especially the jobless claims have come down? Do you think it is a positive sign for U.S. economy?
Yeah, look, I think the economy is, the U.S. economy continues to be very flexible and very dynamic, although it is facing some challenges from the changes in immigration rules and enforcement, as well as the tariffs. The economy itself is probably in pretty good shape, right? The main imbalances are not in the private sector, but in the public sector. So we don't have the kind of things that usually cause a recession after the Fed has been tightening very rapidly, right? When private credit credit in the private sector, that is, not the private credit asset class per se, but credit in the private sector starts to come under a lot of pressure because interest rates have been raised over a period of time by the Fed. We're not in that kind of environment. So I would see this as a kind of recalibration, like I say, towards neutral, because we still do have an economy that is performing well, although it is showing signs, at least in the labor market, of adjusting to a new reality, which is a much lower rate of immigration and labor force growth than we've had before.
Point well taken here, but more importantly, how do you think the situation is going to unfold now? Because that the impact of tariff is something which is still uncertain. However, do you think it will be better than the anticipation now?
Well, look, I think there are a lot of different stories depending on which tariffs you look at, right? I mean, of course, there's an overall situation, which is that the tariff rate is a multiple. The effective tariff rate is a multiple of where it was. It's close to where it was 100 years ago, during the Great Depression, and so on and so forth. But I think that for the bulk of U.S. trade, from the point of view of the U.S. itself, the tariffs are nowhere near as bad as originally advertised, right, on Liberation Day. It looks like, for example, if you take the developed world, most of the tariffs, there's some sectoral tariffs that are above this, but a lot of the tariffs are sort of in the 10 to 15% range. And of course, U.S. Trade with Mexico and Canada needs to be sorted out fully under the USMCA. There's still some uncertainty about where the tariffs will settle with China. And of course, in the case of India, the tariffs are much higher than anticipated. But for the bulk of the trade, the tariffs are perhaps lower than threatened, right? And probably not that high that they would discourage trade or destroy demand, but high enough to generate some fiscal revenue, right? Which is what seems to be happening. So I think the story is not great, but it's not the disaster or the kind of shock that we started to fear on April 2nd, right? It's much more alleviated than that, and has been really since April 9th. So I think that there's more to come in terms of the changes of some of the prices in the economy from the tariff side, but it's not as bad as people were going to worry about in the early stages, right? So I think we're settling here somewhere in the middle, and the U.S. economy will be able to adjust to this. I think the bigger challenge is that in certain sectors and certain economies, including India, that have been hit with much higher tariffs than anticipated, there needs to be some work done, maybe a lot of work done, depending on the country, to offset the impact of those tariffs. India is certainly moving in that direction. Canada is trying to move in that direction. European Union trying to move in that direction by reducing internal barriers to trade and activity and investment. And I think that's, in a way, it's a good thing. It's probably not the best thing that it was necessitated by this turn of events in the U.S., but it is a good thing that this is happening. That there's this kind of response to the rise in protectionist barriers in the U.S., and I think the markets would like to see more of that,
Right,
including
Mr.
from India.
Das, point well taken here. Of course, these are the events which we need to watch out for and how the situation unfolds. Thank you so much for taking out your time and joining with your view.
My pleasure. Thanks for having me.